Good morning, viewers. My name is Natalia Amutana, and welcome to our third program for Accounting Grade 10 and 11. Today's topic is about provision for doubtful debts. The lesson objectives are: number 1, explain the meaning of the term provision for doubtful debts. Number 2, explain the need to provide for doubtful debts. Number 3, explain how provision for doubtful debt is estimated. Number 4, prepare the entries for creating provision for doubtful debts. And lastly, prepare the entries for increasing and decreasing the provision for doubtful debts. The term provision for doubtful debts can be described as an estimate of the amount which the business will lose due to possible bad debts. The business is expected to provide for doubtful debts because of the matching principle as well as the prudence concept. The matching principle states that revenue is recognized from the credit sales during the financial year should be matched against any expenses for the same financial year. The prudence principle states that if the business anticipates that some of the debts may not be collected, it is prudent to recognize this loss in the income statement as an expense so that our profits are not overstated. Provision for doubtful debts is estimated as follows. Number 1, estimating past experience. Number 2, making use of aging schedules. Number 3, current economic condition. And lastly, by looking at the debtors account. A business needs to create a provision for doubtful debts account if it did not have one in the previous years. For example, debtors are owing 5,500 Namibian dollars at the end of the year, and the provision for doubtful debts is maintained at 2% of the debtors. The provision for doubtful debts account is created by first taking the amount owed by the debtors, which is 5,500 Namibian dollars, and multiplying by the 2% over 100. The provision for doubtful debts will then be 110 Namibian dollars. The business anticipates that 100 Namibian dollars from the current amount owed by debtors might be bad in future. This anticipated future loss is charged in the profit and loss account as an expense. Therefore, profit and loss account will be debited, whereas provision for doubtful debts will be credited. For businesses that had an account of a provision for doubtful debts in their records, there is a need to either increase or decrease the provision for doubtful debts at the end of the financial year. The provision for doubtful debts account balance will always be on the credit side. If the provision for doubtful debts is increasing, the difference is recorded on the credit side of the provision for doubtful debts account. This represents the future losses from the current debts. The profit and the loss account will therefore be debited. If the provision for doubtful debts is decreasing, the differences is recorded on the debit side of the provision for doubtful debts account. This represents the gains from the total amount we initially expected to lose. The profit and loss account will therefore be credited. Let us refresh our mind on what we have learned today. We have learned about the definition of provision for doubtful debts, as well as the procedures for recording when it is an increasing and when it's decreasing. Before we say goodbye, let's look at the question based on what we have learned today. A. What is the provision for doubtful debts? B. Explain the need to provide for doubtful debts. C. How is provision for doubtful debt estimated? 4. State the double entry for when provision for doubtful debt is either increasing or decreasing. Until next time, goodbye.